Hi, so today we're looking at the Swiss-based consumer electronics company Logitech. You will probably be familiar with Logitech products, things like webcams, computer speakers, keyboards, mice, things like that. Now they have been a big beneficiary of the pandemic, so we will take a look to see whether they are a good investment or not. Now for those of you who are new to my channel, well, welcome aboard. I'm going to analyze the company Logitech today by looking at the industry they're in, the competitive forces that they face, the management team running the business, my valuation, and then my opinion. And if you don't know some of the terminology that I use, look, don't worry at all, just sit back and follow along as best you can. It's part art and part science anyway. What I'm trying to do is help as many people as possible understand what they're actually investing in, because most people spend more time researching their next TV or refrigerator than they do their next investment. Now, I get a lot of comments, people asking me to look over a stock. Now, if you have a stock you would like me to cover, please make sure to tell me some real reasons why it is a potential 100 bagger. So that's a stock that can go up 100x over the next few decades. So Logitech have a pretty simple business. They make consumer electronics. Now, consumer electronics is a brutal industry. Literally hundreds of competitors that can make competing products at extremely low prices. But Logitech have been around for a long time, and you'll see when we get to the finances that they are a big player in the industry. Now, they are definitely in a growing industry, and it's only set to continue growing well into the next decade. Something that this graph fails to show is how the industry has taken off in 2020, nearly tripling in demand with the stay-at-home orders. Think about all the people needing decent webcams, headsets, and home offices. The pandemic was a massive catalyst for the company, and they were in the right place at the right time. So profit has skyrocketed recently, and so has the share price. Now that doesn't necessarily mean we have missed the boat here. Maybe the market hasn't truly valued the company. But I'll say it again, consumer electronics is a brutal industry. Competition is fierce and fast moving. Maybe keyboards and mice will disappear quickly with the rise of virtual reality. Logitech are active in VR accessories, so it will depend on how well they can execute on their future challenges. Now, this part is a bit unfortunate for me because the market cap has gone over $18 billion, and that's above my preferred $10 billion. I'm actually starting to focus more on $1 billion companies and less, so at $18 billion, it's maybe a bit too late. And another thing that's a bit disappointing is none of my favorite super investors are invested in the company. It would be nice to see someone I think is far smarter than me and better at investing have a big stake in the company, but look, oh well. So for me, I'm actually on the fence here with the industry. I would want a good margin of safety as I just don't feel that comfortable in the consumer electronics industry. So this is cool to see. Logitech has a big market share in lots of categories. This is the gaming mouse category, which has seen huge growth over the past year. I like the computer gaming trend that I think is a long-lasting, and any company in this world that provides great products will make a lot of money. Logitech are right at the top of this market. Regarding competitive advantage though, the only thing I think they can hold on to is their brand. Logitech is associated with good quality, affordable, reliable, yet simple products. They have a good reputation amongst the industry, mostly because they have been around for decades. But look, I'm not loyal to Logitech. What I mean is that there is no status points for having a Logitech mouse or a Logitech keyboard. If I get a great product at a cheaper price, I'll happily get the cheaper one. As competitive moats go, my opinion is that it exists, but it's not the strongest moat in the world. Durability of the moat is my issue, and I think they could be disrupted. But on the other hand, they are showing great signs of having a good competitive advantage right now. These are the recent results from the company's quarterly update. Sales have gone up 80%. Gross margins have gone from the mid 30% range to mid 40% range. Growing gross margins is a good sign of a competitive advantage, so people are willing to pay more for their products, and Logitech can charge healthy prices. They don't need to compete on price when you have a competitive advantage. So this growing gross margin is a good thing to see, and maybe I am wrong about that weak competitive advantage. Now looking at operating profit and operating cash flow, well, they have both tripled. This just shows how well positioned they were to take advantage of this work from home world. And regarding the book value of the business, well, it has followed a similar path. Financially speaking, everything couldn't be better for Logitech. And I think that I have to give them a tick here, even though my gut feel is that the competitive advantage might not be that strong. I'll still think about this when we get to the valuation part, but look, great finances. Bracken Darrell, the CEO, has a cool 765,000 shares in Logitech, and at today's value, that's about $850 million worth. So he is pushing the billionaires club. And I really like it when a CEO has a big stake in the company just like this. So his net worth is tied to the performance of the company. One of the big common elements of a 100 bagger, so a stock that goes up 100x, is that the CEO has a big stake in the company. So really good to see here. Regarding debt, the company has practically no debt, so that is another good sign of good management. Then we turn to return on invested capital, or ROIC, and it's one of the most important metrics of a 100 bagger too. It is how much money the company makes on the investments in the business. It is a sign of compounding, which means the business each year makes money, invests that into the business, and then makes even more money the next year. Anything above 15% is good, and the higher the better. So how impressive are these return on invested capital percentages over the past 5 years? Not only stable, but really high. This is a compounding beast, something that gets me very interested. Now, on top of this, the last couple of quarters with the massive jump in sales, the return on invested capital is actually in the 100% range. Management definitely gets a big tick here, and I'm very impressed. Now, we've already seen the stock price has gone crazy, so getting the right value here is going to be very important because we don't want to overpay for a company that's only worth $20. We're not going to pay $100 for it. So the first way I'm going to value it is to look at the price to free cash flow, and that is the relationship between the stock price and how much free cash flow the company is making. I then factor in the growth rates to get a target price to free cash flow number. Look, this is a very rough way to value a company, but it is pretty good to get a ballpark figure and to then compare that with my discounted cash flow method. So future growth rates is where things get actually pretty difficult. Predicting the future is just nearly impossible. Yahoo analysts think 32% growth per annum over the next 5 years. But some of these analysts range from 5% growth rates to 50% growth rates. So it is a big difference of opinion. Now, my theory at the moment is to assume that 2020 was an abnormal year, and the growth from, say, 2015 to 2019 is probably more in line with what will happen moving forward, which was about 20%, and that feels more realistic. I would also assume that the next 12 months, the numbers might drop down as the initial massive increase won't be able to be kept up. So with the current price to free cash flow currently at 20, the stock price is actually not too overpriced. So that gives me a little hope. Now, if I look at my fair value calculator, which factors in more information, and if you want a copy of this, it's free and it's in the description. Now, I'm using 20% for the next 5 years and 15% as my estimated growth rates. My return on investment goal is normally about 15%, but I push to get 20% so I have a margin of safety. I'd even feel more comfortable at 22%. Now, to get the multiple I could sell it for, what I do is I get the historical average PE, which is about 20. So that's what I should get in the future. So that's what we'll use as the multiple. Now we're going to look at the free cash flow, and I've actually taken 20% off their free cash flow number. And that's because I think 2020 is an exceptional year, and repeating that will be just unlikely. Look, that's just my opinion. I could be very wrong here, but look, I like to play it safe. So then I put in the shares outstanding, the cash balance and the debt balance, and the calculator says that we have a price at about $100 would be a pretty good deal. Now what I like to do is try to be a bit more cautious because remember, I'm not completely sold on their competitive advantage. Plus the industry is highly competitive. So I want to take some of that risk off the table. And the best way to do that is to just pay a better price. So what I've done now in my calculator is I've reduced the growth rates and increased my margin of safety. And after that, we get a price of around $80, and that just feels far better for me. So the negatives I see are this. The industry they are in is a fast-moving and difficult industry. I'm still not entirely confident in their competitive advantage either. Brand is all I see, and that isn't the strongest brand name in the world. I really do prefer companies that are less than $1 billion, and that's something I'm really focusing on at the moment. So at $18 billion market cap, it's just a little bit too big for me. Plus, none of my favorite super investors have invested in the company. But the positives are many. They have growing gross margins. They have great historical growth rates, a heavily incentivized CEO. They have fantastic compounding metrics and no debt. Now, I feel better at $80, which would be about a 30% price fall from current levels. This is early March. That's okay with me. I'll add them to my wish list and see what happens. I'm actually happy to just follow this company for a while anyway and learn a bit more about them. Now don't forget to subscribe so you don't miss my future videos. Hit me up in the comments if you have an opinion about Logitech or maybe another proven company that has big upside potential. And obviously, you will need to investigate a lot further if you want to invest yourself, but this hopefully gets you started. And a big thank you for staying to the end, and I will see you in the next video.